Hello and welcome to Market Guru. Joining me today is Tarun Kataria. Thanks very much, Tarun. Always a pleasure talking to you. We spoke in December, and I remember things were very different back then. We started with Europe. We talked about US. You did mention that Europe is not something which is going to go away in a hurry. But since then, we've seen such a shift here back home. We've seen the sharp rally. We've seen a bit of a sharp correction as well, if you see the last few days. What are you making of the market at this point of time?
I think we're sort of back into somewhat of an uncertain period again. I think we had a good run based on it was, new allocations to emerging markets, liquidity being pumped into the system. I think, we've seen almost $1 trillion out of Europe in the last few weeks. So I think that changed sentiment a little bit. But I think we're now sort of back into interest rate mode, election mode, reform mode. So the stuff that we were dealing with Q4 last year, calendar last year, has come to the fore. In the meantime, we've had a good rally, which I think changed mood a little bit, but we're sort of in that
Would you say that was just a liquidity-driven rally? Perhaps the market was running way ahead of the reality?
Yes, it was definitely a liquidity-fueled rally. And of course, now the markets usually are ahead of what we think may come. So I think there was a sense that interest rates cuts might come, so we can sort of talk about that a little bit, and the sense that maybe Congress does a little bit more, does something a little bit more dramatic than we're probably seeing unfold at the moment. So I think we're in that sort of quiet period where people are trying to figure out what to do.
So let's talk about interest rates then. March 15th, that's the date. Do you think it's high time? The cuts happened?
I think the market has definitely priced it in. Now,
a cut? A CRR cut or an interest rate cut?
Both. I think market's talking certainly April that there will be an interest rate cut as well. It's not necessarily that straightforward. There's a risk, right? Because if you look at what's happened over the last few months, consumption hasn't slowed as much as production has. And to me, that's inflationary, right? So that's the one end of it. And the other end of it, people are saying, okay, now you're at 6.1% GDP, last Q, you've got to cut. My sense is that they've priced in very aggressive rate cuts. And that would be my concern. If that doesn't come through, then your discount rate changes again and the market sort of does what it needs to do. So I don't think it's that straightforward. I mean, we talked about this the last time. My view was it's 3 or 4 months away from December. And I still stick with that. So they might do a small cut, but it's not that straightforward. And that's the point I want to make.
In fact, we just heard one of the senior RBI deputy governors saying yesterday that, look, our concern is inflation. We're not so much concerned about growth as much as we are about inflation. And the point you're making is that's not gone away.
It hasn't gone away. In fact, I reckon it accelerates at some point because, consumption is declining much slower than production, right? Now, if you've got consumption here, production here, it's inflationary. It may not be today, but in 6 or 8 months from now. So you can't have a situation where they cut 50 bips and then say, gee, I've got to take rates back up again. So that's really the risk.
But what's the picture on the ground as far as corporates are concerned, Tarun? Because, they're squeezed for liquidity. We've seen that play out very sharply. CapEx hasn't turned around. We're not seeing capital expenditure from the private sector. Yeah. So isn't that, as you said, the two sides of two extreme problems here, that on the one hand, if you don't do this, you're not going to see strong earnings coming around. You're not going to see CapEx happening. Yeah. Is that a point of concern as far as the markets are concerned for you?
It's a point of concern. I mean, private CapEx is basically down to nothing. In fact, it's less this year than it was last year. If you look at the stats, the charts are pretty much one way. But, runaway inflation is not something the RBI can really handle, so they have to be careful. And as I just said, you've got this disconnect between consumption and production. That is inflation, and my suspicion is that's what they're really watching. So yes, 6%, down from 9 looks terrible, but they've got to watch this. And they watch over the next 12 months. It's not sort of, month to month. Now, that doesn't work for industry, clearly, and we're seeing that in, private capital formation and private sector CapEx, all looking pretty poor. But that's part of the uncertainty which will keep markets sort of hanging a little bit.
We keep hearing this word resilience of India Inc. quite often these days. Do you think somewhere, at some point of time, that's going to break if this continues?
Well, listen, at the end of the day, it's still 6% GDP growth, right? And when you compare it to pretty much anywhere around the planet, with the exception of 2 or 3 emerging markets.
Earnings? That would at some point get
corporate
hit, right?
earnings are under pressure.
As you mentioned.
Corporate earnings will be under pressure, and with oil doing what it's doing and the rupee uncertainty coming back to the fore again, flows drying up. So all of that stuff starts again. I guess let's watch what happens, with the tie-ups in the next couple of days and see if reform perhaps is the catalyst to get the mood changed. And I think that's really what we're all waiting for.
Do you feel that if pushed to the wall, I mean, there are two ways to react. One is you go into your shell, and the other is you probably come out even more strongly and say, look, I've got the message clear, I need to do more. What do you expect the government to do?
Well, I'd like to think, or we'd all like to think, that they'll do a bit of the latter, which is, sort of get on with it and do stuff and, put reform in place. But listen, we've said that for 7 years. I don't think it's necessarily played out the way we'd like. So the jury's out whether they can actually. It's one thing to say this is what I want to do. It's another thing to be able to implement. And, in a raucous democracy like we have, that's always tough to do.
What's the mood among FIIs? You would be talking to a lot of them. We did see a gush of dollars coming in. Do you think that's going to continue, or do you think that there's going to be a pause?
My suspicion is it's a function of what we see in the next couple of days. I think if you look at sort of the first 2 months where we saw, if you take the HDFC bit out, I think you saw about $5 billion of flow in 2 months, which is pretty dramatic. And you've seen 60 odd million bucks month to date. So obviously there's a sense, let's hold back, let's see what the RBI does, let's see what the election results are. If you go into that sort of zone of uncertainty like we had Q4 last year calendar, I think things will, the gusher won't happen as we saw in January and February. So I think, as I said, we're in that sort of uncertain phase at the moment. Generally, the mood is slightly better than it was through much of last year. Is it a game changer like, it was in Jan, Feb? We'll have to see. But right now, if you look sort of from a today perspective, not necessarily going to be the first 2 months.
There are some experts who are willing to go all the way to say that we'll probably get about 30 to 40 billion in the next 2 years, 2 to 3 years. Do you hold that view? From what you see, the kind of liquidity out there, it's obviously a small percentage which has moved in so far. Do you think and believe that that's the kind of flows we could get?
I think that's entirely possible. And if you're talking 2 years, you're really saying 15 billion for each of the next 2 years, of which 5 have already showed up. So yes, I think it's entirely possible. Global liquidity will continue to be there. Europe, from a growth perspective, probably bottoming, but it can't really grow beyond 1.5%. So the emerging markets will continue to be the story that unfolds, and India clearly is very much part of that. I think if we see reform and you see something happening from New Delhi, that 30 billion can be a small number, and I think that's all we're looking for.
And would the first sign of that come in the budget? What would you be looking for there?
See, I think we all make too much out of the budget. Budgets. It's mathematics, right? Income, expense. So I think from my perspective, what we need to make sure is that expenditure is curtailed. You've got now $50 billion of subsidies, right? You've got, I think, 68% of government revenues are now interest rates and subsidies. That's not sustainable. That's up from 41% 3 years ago. How do you grow an economy? How do you invest in economy if almost more than 2/3 of what you take in is spent on this? That's the stuff you've got to deal with. The reforms can come outside of the budget, that's fine. Control your spending and invest for the long term. That's really not happening. Subsidies to rule India, great, but that's not investing for the long term. Narega is not investing for the long term. Narega, as we've discovered,
It's a capital expenditure on the government.
It's huge, and it's creating an economy where people actually don't want to work. Right? We've just done the second Great India road trip where we take a group of FIs, and that's also come up, that actually guys don't want to work. That's not an emerging economy you want to build. So you've got to invest in education, you've got to invest in healthcare, you've got to invest in the environment, but with two-thirds of your revenues going to interest rates and subsidies, it's very hard to do.
Tell me a little more about that roadshow. What really came up there? What were the other thoughts that emerged?
Rural economy, Little India doing extremely well. The consumption story continues unabated. Narega, not the best thing that's really ever happened in that sense, because you're creating guys who just sort of sit under trees and don't do anything. Labor shortages are being created. SUVs are being bought like they're going out of fashion. So that's really what we're discovering, that, rural India doing extremely well, consumption story unabated, that stuff's happening. But, at some point, and the wealth effect, I guess, from land sales, land value, is driving that. Yeah. But, it takes two sides, right? If urban India, industrial India, private sector India is struggling, you've got to get that balance back again.
So you do believe after this trip that the consumption story is far from playing out? Many would say those stocks are fairly expensive. But from what you're saying, that if there is so much of demand continuing, that probably has still some legs to go.
I think there's some legs to go. And listen, we've said this before, equities is not a 6-month story, right? If you believe long-term that emerging India, consumption India, and you must have a 5-year view, 6-year view, 10-year view on equities, then, I'd still play that.
I remember we talked about where you see the markets, and we started sometime about 6 months ago where you were fairly bullish. You thought this market had it in it to go up to all the way to 24,000. Then we of course saw some pretty bad times, and you scaled that down to about 20,000, Tarun.
18.
Okay, 18. My record shows 20, but anyway, we'll give and take those 2,000-3,000 here and there. But what's your sense next 6 months to 12 months? How do you see things panning? Of course, you've got those triggers. You've got the March 15th policy. You said it's already factored in a bit of a cut. You've talked of the budget. It's that whole big fiscal number and the way the government spends, which is what you're going to look out for. Post that, do you think, given the liquidity point that you made and given how dependent we've been on foreign flows, and if that's the kind of money we get, do you see the trajectory of this market taking off?
It's a good question. See, that it really is driven by FIs. Ultimately, the correlation between all emerging market indices is very highly correlated with flows. So if you believe flows drives this, then you've got to ask the question, what drives flows? And what drives flows is macroeconomic, sensible policies, all the reform stuff that we've talked about, a different trajectory of interest rates. If those things come to pass, then the market can certainly head much higher from here because, we've sort of come off distressed lows. I don't think we're nearly fully valued at the moment. It can go higher from here, but it can go higher if FIs sort of bring their cash in, FI bring their cash in based on these 2 or 3 things. So you'll have to wait and watch what comes out over the next 6 weeks.
What's the mood among retail? Are they coming back into the market?
Retail is definitely coming back. There's a sense that, not a sense, the retail is coming back into the mid-cap space. Retail flows are up by 1/3 over calendar Q4 last year. A lot of interest in commodities. So yes, retail is back, but it's not back to what we saw 2 or 3 years ago, sort of pre the credit crisis.
Would the interest rate sensitives be your big play in terms of sectors for this year?
Yes, we like some of the mid-cap banks. We certainly like State Bank of India, Yes Bank, HDFC. So yes, if you look at our top 10 picks for 2013, I think 4 of those are FIG names, and we like some of the mid-cap names as well. Generally, we think IT is kind of fully valued at the moment. So that's yes. So to answer your question, yes, absolutely.
What about the whole disinvestment story? Do you think we've just seen something not very encouraging?
Story is a polite word. Well, it all comes down. Obviously this sets it back a little bit. I think to try and do stuff at a premium, given all the uncertainties about the company and the sector, may not have been the right thing to do. Certainly, getting the LIC to bail you out every time something goes wrong is not the right way to do it. But I think for the right companies at the right price, there's a story there. So let's see what. Yeah, absolutely.
Are you seeing interest picking up at all in the entire mutual fund insurance space?
I think on balance, there's been a huge amount of redemptions in the mutual fund space. And if I have my numbers right, it's sort of $3.5 billion from the start of the year, which actually is a lot of money. So I don't see a catalyst to necessarily change that. Obviously, if you see a material run-up in the next few weeks, maybe retail comes back into the mutual fund space. But right now, it's still in redemption mode. So
in other words, we are going to remain a largely FII-induced kind of a market for the next quite a few months.
Few months and maybe a few years, because I think you look at even, economy is slightly larger than ours, very dependent on FI flows, and more so for us where you've got, the kind of deficits that we have.
Other than interest rate sensitives, what are the other sectors that you would like over the next 12 months?
I think we've got sort of, and I'm going from memory here, Crompton Greaves, Bata, so those are some of the mid-cap names that we've sort of put on our top 10 list. Some of the FIG names, as you mentioned, those are the ones that we're sort of looking at the moment.
You would be willing to go away from the defensives at this type of a market?
Well,
2011 was largely about just staying with the defensive.
You may want to go defensive for the next, month, 6 weeks, 8 weeks, but thereafter, I guess, depending on what sort of comes out of the polls, then you need to think a bit differently.
Overall, 12 months, bullish?
Yes, I would say constructively bullish.
Constructively bullish. Okay, on that note, thanks very
Great,
much. Thank you for
Good
joining
to be
us.
here.
Thank you. All right, that was Tarun Kataria. We take a quick break. We come back and take your stock and mutual fund specific questions on Talk Money.